You got the letter. Claim denied. 3 words that feel like a wall. And at the bottom of that paperwork, the explanation of benefits, there's a little code, 2 or 3 characters. Maybe a number, maybe a letter, maybe both. And the insurance company is betting you have no idea what it means. Here's what they're not telling you. Some of those codes are genuinely final. Fight them and you'll lose. But one of them, a very specific code, means your insurer already ran the numbers internally and determined they probably owe you the money. They just sent the denial anyway. Everything in this video is for educational purposes only and does not constitute legal or financial advice. Here's why this keeps happening to so many people. The explanation of benefits, the EOB, is intentionally designed to look like a final verdict. Most people see denied. They see a code they don't recognize, and they assume the decision is over. They move on. They pay the bill themselves, or they go into collections. And the insurance company counts on exactly that. The numbers are brutal. Research from the Kaiser Family Foundation found that fewer than 1 in 10 denied claims are ever appealed by patients. That means roughly 9 out of 10 people who could fight a denial, and many of them could win, just don't. In marketplace plans alone, insurers deny roughly 17% of in-network claims. If your out-of-pocket share on a denied claim is even $2,000 and you never appeal, that's $2,000 the system quietly transferred out of your pocket. Now, the codes themselves come from a system most people have never heard of. They're called CARC codes, Claim Adjustment Reason Codes, maintained by a group called the Washington Publishing Company under contract with the Centers for Medicare and Medicaid Services, CMS. When a commercial insurer denies or adjusts your claim, they're required to attach at least one of these codes. The problem is, they never explain them in plain English on the EOB. They just print the number and move on. So, you're holding a document that looks official, looks final, and contains a coded message that most Americans were never taught to read, until now. Let's go through 7 of the most common denial codes you'll see on an EOB. And for each one, we're going to tell you what the insurer is actually saying, what they're not saying, and whether it's worth your time to fight it. Code 1. CARC Code 1. Deductible amount. This one means the insurer isn't denying your claim because the service wasn't covered. They're saying the service is covered but you haven't met your deductible yet, so you owe the contracted rate. Here's the distinction that matters. The claim was processed correctly. The denial is actually a cost shift, not a coverage denial. You still owe the money, but to your provider at the negotiated rate, not the full billed charge. Fighting this code is usually not worth it unless you believe your deductible tracking is wrong, which does happen. If you've had other claims earlier in the year, pull your deductible accumulation history from your insurer's online portal or call member services and ask them to read you the running total. Math errors in deductible tracking are more common than you'd think. If the numbers match, accept it and move on. If they don't, that's a billing dispute, not a clinical appeal, and you can win it with paperwork alone. Has your insurer ever miscounted your deductible or applied a payment wrong? Drop it in the comments. I read every one. Code 2. CARC Code 2. Coinsurance amount. Same structural idea as Code 1 but applied after the deductible. You've hit your deductible, but the claim is in the coinsurance phase, meaning you owe your percentage of the contracted rate. 20%, 30%, whatever your plan specifies. Again, this isn't a clinical denial. It's a cost share calculation. The question to ask here is whether the provider billed at the contracted rate or at the full chargemaster rate. If the insurer applied your coinsurance percentage to the full billed charge instead of the contracted rate, that's an error, and it happens. Pull your Summary of Benefits and Coverage, the SBC, which every insurer is required to provide under the Affordable Care Act. Find your coinsurance percentage. Then, find the contracted rate for the service on your insurer's provider portal. Do the math yourself. If their number doesn't match yours, file a billing dispute. That's a winnable fight. Good fool. CARC good fool. The service is inconsistent with the provider type. This one starts to get more interesting. What the insurer is saying here is that the person who performed the service, in their view, doesn't match the category of provider that's covered for that service under your plan. A classic example. A nurse practitioner performing a service your plan only recognizes when performed by a physician. Or a physical therapist billing under a code your plan says requires an orthopedic specialist. Here's the thing about this denial. It's often wrong. And it's often wrong because the provider billed under the wrong code, not because the service wasn't covered. That's a correctable billing error. You don't need a lawyer. You need the provider's billing department to resubmit with the correct modifier or the correct provider credential attached. Call your provider first, not your insurer. Ask them to review the claim and resubmit with the appropriate taxonomy code for the treating clinician. In many cases, the denial evaporates within 30 days. Code 50, CARC Code 50. These are non-covered services because this is not deemed a medical necessity by the payer. Now we're into the territory where the real money fights happen. Medical necessity denials are the most common serious denial type, and they're also the most commonly overturned on appeal. The insurer is not saying the service doesn't exist or that your doctor didn't order it. They're saying, in their clinical judgment, it wasn't necessary. But here's what that actually means. An insurer's medical necessity determination is made by reviewing criteria from a private organization called Milliman or Interqual, not by a doctor who examined you, not by your treating physician, often by a nurse reviewer, following a checklist under a federal regulation called the Mental Health Parity and Addiction Equity Act. And under ACA provisions that apply to most commercial plans, insurers are supposed to apply the same medical necessity standards to mental and behavioral health care that they apply to medical and surgical care. They routinely don't. If you get a code 50 on a mental health or substance use denial, that's a federal parity violation and it's worth fighting hard. For other service categories, you need your doctor to write a detailed letter of medical necessity, citing the specific clinical guidelines, whether that's the American College of Cardiology guidelines, the NCCN guidelines for oncology, whatever is relevant. That letter changes the calculus on appeal significantly. If a medical necessity denial has ever blindsided you, and you had no idea you could fight it with your doctor's letter and a federal parity argument, that's exactly the kind of thing we break down here every week. Subscribe. Because next week we go deeper into the appeals process itself, step by step. Code 97, CARC Code 97. The benefit for this service is included in the payment or allowance for another service or procedure that has already been adjudicated. This is called claim bundling, and it's one of the most opaque denials you'll ever receive. What it means is the insurer is saying two services were billed separately, but in their view, one of them is already included in the payment for the other. Insurers use something called the NCCI, the National Correct Coding Initiative edits, which were originally developed by CMS for Medicare billing and have been adopted in some form by most commercial payers. Here's the counterintuitive truth about bundling denials. They are sometimes correct and sometimes completely wrong, and the difference depends entirely on whether the two services were truly performed as a single procedure or as two distinct, separate clinical encounters. If they were genuinely separate, the provider needs to add a modifier, specifically a modifier 59 or an X modifier, to the claim to indicate they're unbundled for a legitimate reason. Again, go to your provider's billing department first. If they confirm the services were genuinely separate and distinct, ask them to resubmit with the correct modifier. This is not a patient appeal. This is a provider billing correction, but you have to know to ask for it. Code 181. CARC Code 181. Procedure code was invalid on the date of service. Straightforward on the surface. The insurer is saying the billing code used doesn't match the version of the code set that was current when the service was performed. Medical billing uses something called CPT codes, Current Procedural Terminology Codes, published by the American Medical Association, and they update annually every January 1st. If a provider submitted a claim using a code that was retired or modified before the date of service, you get code 181. This one is almost always a provider billing error. It's correctable, and it should be corrected at zero cost to you. The provider resubmits with the correct CPT code. Done. What to watch out for? If this keeps happening with the same provider, it may indicate their billing system isn't updated properly, which can create bigger problems down the line. Mention it to their billing department as a pattern. And now we're at the code that makes this whole conversation worth having. CARC Code 197. Pre-certification, or authorization, or notification absent. This is the one. Let's be precise about what this code actually means in practice, because the surface reading and the real-world implication are completely different things. On the surface, the insurer is saying the claim was denied because prior authorization wasn't obtained before the service was performed. Simple enough. But here's the mechanism underneath that. Prior authorization requirements are plan-specific, and they change. Insurers update their prior auth lists regularly, sometimes mid-year. Under the No Surprises Act and under CMS transparency rules that took effect in 2023 for Medicare Advantage plans, insurers are required to maintain accurate, current, publicly accessible prior authorization requirement lists. If the service you received was on that list as not requiring prior auth at the time of service, and the insurer later denied it with Code 197, that's a compliance failure on their part. Not yours. But here's what makes Code 197 specifically significant, and this is the part most people never find out. When insurers conduct internal audits, they review prior authorization denial rates and overturn rates. A pattern of Code 197 denials that are subsequently overturned on appeal is a red flag that their own internal compliance teams monitor. Why? Because under ERISA, the Employee Retirement Income Security Act, and under state insurance regulations that mirror it for fully insured plans, insurers have a fiduciary duty to process claims accurately. When an insurer denies a claim with Code 197 and their own authorization database shows no prior auth was required, that's a situation where the insurer's internal records are inconsistent with the denial. That inconsistency is often what drives internal overturn, sometimes before you even get to a formal external appeal. Here's how to fight it. Step 1. Pull the insurer's prior authorization requirement list for the date of service. Most insurers are required to post this publicly. If you can't find it, call member services and ask them to confirm in writing whether prior authorization was required for the specific CPT code on the date of service. Get that answer in writing, by email or by member portal message. Step 2. If they confirm no prior auth was required, submit that confirmation with your appeal. That documentation alone has overturned Code 197 denials without any clinical argument at all. Step 3. If the insurer says prior auth was required but your provider believed it wasn't, check whether your provider attempted to get authorization and was given incorrect information. That's a different fight, and it involves your provider's records of any pre-service calls to the insurer. Under the Consolidated Appropriations Act of 2021, plans are required to have a process for providers to confirm auth requirements in advance. If there's a documented call where the insurer's rep said no auth was needed, that's powerful. This is the code the insurer is hoping you just accept. Because if you do the homework, the overturn rate on Code 197 denials with proper documentation is significantly higher than on clinical necessity denials. The denial wasn't random, but neither is the appeal. So here's the framework. 7 codes. Very different fights. Codes 1 and 2 are usually math checks, not battles. Code 4 is a provider billing fix, not a patient appeal. Code 50 is the clinical battlefield, and it's winnable with the right documentation and the right federal argument. Code 97 is another provider billing correction that most patients never trigger. Code 181 is a coding update error, correctable, no clinical fight needed. And Code 197, that's the one where the insurer's own internal records may already contradict the denial they sent you. The system isn't complicated because the rules are complicated. It's complicated because they need you to feel like it is. Every one of these codes has a mechanism behind it. Every mechanism has a crack, and every crack has a documented path to appeal. One more thing before you go. The window to appeal a claim denial under most commercial plans and under ERISA is 180 days from the date of the denial notice. Under ACA marketplace plans, you often have 60 days for internal appeal. Do not wait. Pull the EOB, find the code, identify which category it falls into, and start the clock. Next up on the channel, we walk through the exact internal appeal letter that overturns medical necessity denials, the specific language that makes adjusters pause. That one's already up. Go watch it. And one question before you go. Which of these 7 codes showed up on your last denied claim? Drop the code number in the comments. Let's see what you're actually dealing with and whether it's worth fighting.